Good day and welcome to this, the fourth in our series on the Kerner Perspective market reports and asset market reports. Today we're going to be covering the KP, the Kerner Perspective Offshore Portfolio Commentary, again for the period to the 31st of December 2023. Just a few of the more recent actions that we've taken in offshore portfolios in the last 18 months or so. Quite recently, in fact, very recently, we added a US Treasury bond ETF. As we said in the asset market review, bond yields there have moved up quite nicely, and we see a tactical opportunity to secure both good yield to maturity as well as the probability of some capital return. And there's somewhat of a Fed put bet on there, but we feel we're fairly secure, at least for the next year or so. We also quite recently, for those clients that didn't have any Diageo or significant Diageo holdings, we added some of those after the Latin American operations caused a bit of a sell-off. We bought Microsoft some time back, and as you'll see, that really has worked out quite nicely. We added a few Volkswagen, or bought them for clients who didn't have them. And as you will see, it really has been, I suppose, out of all of the bigger holdings, the thorn in our flesh. We bought some Richemont and also some Prosus quite opportunistically. Richemont, when we sensed that the market was overstating the fears around China some time back, and then Prosus earlier in 2022, also just when that discount was excessive following the sell-off of Tencent in China on those gaming fears and the tech clampdown. We sold some Shell for quite a few clients, just bringing that holding down to something more sensible. We created some cash for some clients in selling the ultra short bond fund when it was needed. For some clients, for those that were in the US registered because of changes in the tax codes around the treatment of private equity funds, we were forced out of our US holdings in Brookfield Renewable, but not in the Canadian listed. And then for some clients, we would have offset capital gains by selling some GE. I think a question that you may well ask is, in segregated direct asset portfolios, why do we include ETFs? As you'll see, we obviously have the ultra short duration ETF, we've got the Treasury ETFs, but we've also got some regional ones, so both China and Europe. And I think the main reason is, for example, the European ETFs gave us good broad exposure to Europe at a time when it had been sold off courtesy of the Ukrainian invasion. But often it offers a very elegant way of getting good diversification in a very cost-effective way. The fees are low, firstly, but secondly, when you've got a 2 million Rand equity portfolio, for example, it's very difficult to cost effectively build a segregated portfolio that offers reasonable levels of diversification. So generally we use ETFs just for a little bit of tactical betting sometimes, and also for smaller clients, it gives us a very elegant way to get that diversification. And then, as we say, the ETF costs are very, very low, particularly iShares. You're often looking at sort of 10 basis points. And we generally, if we wanted to take a bet on Europe, we would say we want a broad European bet, or if we want to play the US Treasury market, we're very happy to track a benchmark there. We're not necessarily looking for active managers. We're really just looking for, let's call it, thematic exposure. All right, so just having a look at some of the recent performance, and there's obviously some of the bigger holdings and quite a few of the smaller holdings. Yeah, it's a very busy slide, and it's alphabetical, so it's not, unfortunately, ranked in by any sensible metric like weightings, although the portfolio commentary that we'll do now is largely in relation to the holdings. So as you can see, a very volatile period. If you look over a 1 month view, this is obviously to the 31st of December, you can see some strong performances from the likes of Richemont and BNP Paribas and Micron and JP Morgan, all up around 10% on a 1 month view. And then you can see over a 6 month view, Micron, once again, performing very nicely. JP Morgan, General Electric. So generally, you would say it would be the US companies, including the likes of Microsoft, that did quite well there. Yeah, and 3 months, very, very mixed bag. So you see a fair amount of red, particularly on the 3 and the 6 month view. And just looking a little bit longer term, we have the 1 year, 3 year, and 5 year performances here. And as you can see on a 5 year view, the standout performances obviously coming from the likes of Microsoft and Micron, although we have to say we didn't hold Microsoft for much more than 18 months, and even Micron is probably only around a 3.5 year holding. As you can also see there on a 3 year view, courtesy of the Ukrainian invasion and the normalization in energy markets, Shell really one of the star performers, along with General Electric, which was obviously very heavily sold off after the disastrous base set by previous management. On a 3 year view, also quite gratifying to see HSBC recovering nicely, obviously that off that low created by COVID-19. But one or two of them looking quite solid regardless of the 1, 3, and the 5. You've obviously got companies like BMW that are fairly consistent throughout. HSBC barring the 5 year where it's virtually flat. JP Morgan also looking good, as are Microsoft and Micron. So that will just give you a sense, and I think the important takeaway from this is it's been quite patchy, and I think in large part, as we discussed in the asset market review, it was largely US markets that have been performing. Right, then we're going to run through very quickly, and we've got a couple of stocks that we're going to just talk through in a little bit more detail, starting with HSBC. As you can see, end of 2019 into 2020, very aggressive sell-off due to COVID. HSBC has recovered very, very nicely. Unfortunately, as you saw on the 5 year, still very much where it was. We did go into some detail in June of last year, but just quickly, HSBC at a glance, balance sheet, loan to deposit ratio of 60%, high quality liquid assets of $800 billion, common one ratio, tier one equity ratio of 14.7%, $3 trillion worth of assets, obviously including asset management and insurance businesses, but operating in 62 countries, serving well over 40 million customers. And there you can just see how the businesses fit together. You've got obviously wealth and personal banking, corporate and banking, global markets, and then obviously the corporate center, which is really just an expense base. And yeah, you can see there consumer lending, very much a corporate focused business. So the share has done nothing for 5 years, but having a look at how the company has done operationally, of course, 2020, 2021, we had the residue effects of COVID-19, and that hurt the banking sector very significantly. Although, as we've discussed on the South African banks, and the same is true for UK, European, US banks, those aggressive write-downs obviously create a very low base, and you've seen, as you did in South Africa, very significant reversals. So, you've got 10-year CAGR, compound annual growth in earnings per share of 6%. This is obviously to 2023. And just by the way, for the December 23, we're going to assume that those numbers are in the bag. Generally, in international markets, they provide adequately good coverage and feedback to the markets in terms of guidance. So, barring the 2021-2020 period, we would say HSBC has actually delivered quite nicely. It's a more focused business, I think, than it was. They continue to exit certain geographies and tilt capital towards places like China and the higher growth nodes. And there you can see the dividend as well. Obviously, they report in dollars, and the share price that we hold is in pounds, which tends to create a little bit of confusion, but very, very undemanding rating, with 80 pence worth of dividend for this year, and probably a 1.3 almost dollars worth of earnings at £6. It really does look very, very cheap. And as you can see, 24, 25 strong earnings are forecast from HSBC. All right, Micron Technologies has been a very, very volatile. It was obviously caught up in the tech wars between the US and China, a little bit like the proverbial football that has been kicked around. Obviously, sales in this year hurt quite badly, and you'll see the impact of that on earnings in a second. But I think the market looking through that and saying, as makers of NAND and DRAM and solid state drives and the likes, this business is very, very well placed for a very big future in mobile data and storage. Okay, just having a look. Obviously, Micron is a kind of a new kid on the block. Earnings are a little bit erratic. 2023 was an abysmal year on the combination of sales to China obviously falling off a cliff, but obviously they continue to invest heavily in R&D, the net effect of that is 23, 24, not good, but then we expect them to get their mojo back, and that's really the reason that I think that share price has recovered, because I think the market believes that this too shall pass. So, it's an August year end, 2023, as we say, clocked a terrible number. We're expecting that loss to almost evaporate, and then for good things to come. Obviously, not much of a dividend payer. For much of the last decade, they've been investing heavily in R&D, and that's obviously one of the things we like about them. All right, then looking at Shell, as you can see there, the share price basically flat on a 5-year view. We largely bought it when COVID struck and oil traded down to ridiculously low levels, and we were lucky enough to get it at 10, 12 pounds thereabouts. So it's been a good performer in client portfolios, and we haven't held it probably for about 4 years. So that graph doesn't tell the whole story, but you can see 2020, courtesy of the sell-off in energy markets, created a unique opportunity. But on balance of arguments, Shell not doing much. And I think this might partly explain it. If you look at Shell's earnings per share and dividends per share, so you're going back to 2014, maybe looking through to 2020, 2019. As you can see, earnings and dividends actually not going anywhere in a hurry. Dividends quite steady, but the earnings actually from 14 down to 19 went down. Obviously, the strong energy markets we've had in the last year or so, courtesy of the Russian invasion into Ukraine, remembering that Shell's very big in gas as well as oil and sort of downstream. But I think the bottom line is that the reason for this sort of share price languishing a little bit on a 5-year view is really just based, much like Sasol, not going to produce a hell of a lot more, and that clean energy future is going to require both time and capital, and probably will never generate the types of free cash flow that traditional upstream, downstream businesses would have. All right, then Microsoft, a fairly recent acquisition. We got very lucky in around the 240 mark when it got sold down quite aggressively. Sadly, there were a couple of clients who didn't have a lot of cash. We weren't able to take full advantage of this, but from $240, and we'll run through the logic in a second, to now that's almost a doubling in value. Truthfully, it feels, as you would expect in a share that's gone from 240 to 400. We sense that it's a little ahead of the fundamentals, but having said that, it's a good story. And maybe just Microsoft in a nutshell, we did briefly touch on it last time, but they basically operate three segments. They've got productivity and business processes, intelligent cloud, and then personal computing. So the likes of 365 and all the sort of core consumer and commercial products sit in productivity. Intelligent cloud is the likes of Azure and SQL and all those lovely things. And then essentially the personal computing thing is more around devices and advertising, as well as just the traditional gaming business. As you can see here, for FY 2024, the Q2 summary, phenomenally strong growth there. They're looking at $62 billion for the half year of revenue, gross margin of 68%, net income at $21 billion. So, incredible uplift, 18% growth, even in constant currency terms, up 16%. So very, very strong momentum, and that's pretty much in all the business units, as you can see, productivity, cloud, and personal computing all doing their part. All right, looking at Microsoft's earnings and dividends over time, a very, very impressive 14% CAGR in earnings. Beautiful trend line. As you can see, they actually tend to track that trend fairly closely. Dividends not spectacular. They do also obviously return value to shareholders through share buybacks, but a very solid business. And as we say, nobody can scoff at a 68% GP margin and I think a 44% operating margin. Then JP Morgan, another company that we were fortunate enough to pick up in the COVID sell-off, sort of around the $90, and done beautifully well. It's been quite volatile. Just looking at their history of delivery, obviously for a lot of businesses, 2019, 2021 weighed a little bit on and tended to dilute the compound annual growth over, say, a 10-year period. But in spite of that, this beast manages to clock out a very, very decent 6% increase in 10-year CAGR in spite of COVID. And as you can see, dividend really just tracking. We do have a slide on the dividend payout ratio, which is now sitting at about 50%. And the core reason for that is on the left-hand side there, you can see the Tier 1 capital ratio sitting at around 13%, or just a little under that. So very well capitalized. And as you can see, the orange bars are the tangible net asset value. It obviously trades at quite a significant premium to net asset value, but interestingly again is that upward trend gives us a great deal of comfort. All right, then BNP Paribas has also, from the sell-offs in 2020, done phenomenally well. I think we bought it in around the €45 mark. And the core philosophy there was that it was and continues to trade at a discount to its net asset value. And we don't feel that net asset value is quite as vaporous as some people might think. And then just looking at the earnings history, and I think it's something that we always believe is important. Obviously, companies like JP Morgan and HSBC and BNP Paribas have fairly significant investment market exposure, global markets, but they also tend to have very, very predictable and very solid loan books, and they don't tend to experience quite the write-downs that some countries that have slightly more volatile growth, etc., tend to experience. But there you can see 10-year CAGR, 6% in earnings and 12% in dividend per share. Not a spectacular growth rate, but similar to JP Morgan, as we say, good franchises, good investment market business, and solid CAGR. And you can see forecasts for the next 2 financial years, current and the following, remain fairly constructive. So well placed and not looking particularly expensive. If you just look at the forecast earnings there of about €8.50. All right, then Volkswagen is is an interesting business. Sorry, I got these slides a little back to front. We'll look at the price chart now, which is actually quite a sad chart. Just looking at Volkswagen, when you see the share price performance, you sort of say, but how is it possible that this business, if you look at that table on the left, which is busy, I apologize, for the year to 31 December, they delivered 9.2 million vehicles to customers. That was up from 8.2 the year before, so almost 12% growth. You can see great brands from the traditional VW, Skoda, Seat. They've even got Lamborghinis and Bentleys in there for those that are so inclined. So a really good, well-balanced portfolio, which is one of the things we like. And as you can see, it is the biggest car brand or vehicle brand in China by some measure, having shipped 2.4 million vehicles to China in that year. Right, that's the share price. Pretty sad reading, from the time it was sold off courtesy of Dieselgate, fought its way back, was trading well over 250 euros. And then, the market just seemed to fall out of love with him, and the love turned to scorn very, very quickly. And it is quite a difficult one to get your arms around. If you look, for example, at this next slide, which is the first half to June, you saw vehicle sales, as we said, up quite nicely. So from 4 million units to 4.4 million units. And if you look at sales revenue, also up strongly, up 18%. But then, unfortunately, I think the thing that's weighing on the markets, although the revenue and the units were up, the operating results and the margins came off quite significantly. So I think that's really what is nagging the market, which leads us to the slide about, so what is the market worried about? I think the first thing is that if you look at Volkswagen shipments, I think electric powered vehicles represented about 770,000 units out of some 9.4 million units. So it's less than 10% of deliveries is actually electric, which doesn't make sense in a world where, whether it's Europe, China, or the UK, or increasingly the US, where we're seeing new vehicle sales at 25% and more often than not 30% and above. So I think the big fear here is not the near-term deliveries. I think the real worry here is what those Chinese manufacturers are going to do. We're talking obviously EVs. You can see on the right there, and I think Chinese vehicle sales were about 30% electric or hybrid. And you can see the top selling electric vehicles in China. You had BYD, and this is obviously on the models, followed by the Tesla Y, and then a few other BYD models. And you get to the VW ID all the way in position number 17. So I think that is in large part what is worrying the market. I think also increasingly, because of the success we've seen at both Tesla and BYD, but other all electric focused manufacturers, there's a strong preference for vehicles that are built from the ground up, that they are purely electric, and it's not a traditional powered car that you pop an EV or a hybrid powertrain into. So I think increasingly the market's enjoying the potential of pure EV manufacturers. I think there's also a belief, and it's probably somewhat founded, that VW in the past was too focused on the units they sold and revenue and not enough on profit, although that is very much a new strategic focus, is to drive the profits, and they obviously are resizing or right-sizing the business around the world to achieve that. I think the market also believes, obviously, courtesy of the relatively poor positioning in the EV space, that their units and by implication profits will fall over time. And then finally, probably, I I think there's a fear that re-engineering, no pun intended, but re-engineering VW for this new future will require both time and capital, and that will weigh on results. Having said all of that, if you look at Volkswagen's earnings per share and dividends per share for the year to December 23, the PE was on a ridiculously low 4.4, dividend yield of 6.5. Near term, the market is looking for fairly flat earnings. So the question, I think, is to what extent will management be able to attack the cost base and to create new energy in the alternatively powered cars? If they are able to do that, and we think given their history and strong presence and brand power, and there's a very, very real chance that they do that, then this business is looking ridiculously cheap on a, as I say, a sub 5 PE. All right, then we also have for some time held an iShares ultra short duration bond fund. I'm not going to spend too much time on it. There you can see some of the core portfolio characteristics, and all we were trying to do is eke out a little bit of yield in this sort of post-COVID, ridiculously low yield world. It's worked out quite nicely more recently. You've seen yields spike up quite nicely, where the weighted average yield to maturity, as you can see, is over 5%. Duration about half a year, and you can see some of the top issuers there. But all 10 of those issuers, which is BlackRock, IBM, Morgan Stanley, Sprint, you name it, only representing about 7% exposure. Geographically, as you would expect in a USD denominated fund, principally in the US, about 2/3, but also Canada, the UK, and a few others for corporates that are seeking USD exposure. Our plan is to tilt out of these ahead of yields coming off, and probably tilting them into slightly longer duration to try and capture what we feel will be a little bit of capital upside longer in the yield curve. All right, this is Diageo, which we believe is a fantastic business with a great brands portfolio. We've spoken about it before. It's mainly a spirits business, does have a little bit in beer, but it's essentially mainly a whiskey portfolio, brilliantly run, incredible brand power. And as you can see, the share price rallied all the way up to over £40 from about £28 5 years ago, and has come all the way back so that it is now basically lower than it was 5 years ago. As I say, that sell-off late last year in large part triggered by guidance that the LATAM operations are not going to deliver the kind of sales that were expected, and that obviously has taken a few percentage points out of earnings growth, and we believe that that actually offered a unique opportunity because it's one of those that's just always been a little bit expensive. If you look at the history of delivery, again, 2020, 2021 hurt them quite hard, quite badly. You'll remember how, around the world, liquor outlets were closed, bars were closed, restaurants were closed. That obviously hurt the sales quite badly, but you can see that back on track, back on trend. So although the 10-year CAGR in earnings is only 2%, we think if you adjusted for the COVID era, that number would probably be closer to 5%, and that belies the quality of this business. And as you can see, the dividend a lot more steady and consistent, even in that COVID world, than the earnings. But we believe it's a great portfolio. It's really well positioned for a little bit of good news economically, and it is actually quite defensive. Having said that, if you look at the forecasts, earnings, let's take 2023, at about $2 of earnings. Unfortunately, we convert that to pounds. The 28 puts it on around an 18 multiple. And although the dividend yield at a pound is a pretty decent 4% or so, it's not enough to inspire a lot of people. So we think it's better than these charts and the price action suggests. But like so many things, it's just going to require a little bit of patience. All right, then GSK, GlaxoSmithKline. Of course, what is also missing from here is that Haleon was unbundled, and your base cost didn't change for clients, which tends to create a little bit of false reality. GSK, we were always keen on it because of the defensive nature of the portfolio. Strong vaccine portfolio, for example, we thought would shield it. And obviously, there was some benefit in COVID in terms of them having produced a vaccine, but that also came at the expense of a lot of electives and a lot of other vaccine programs around the world being temporarily shelved. So we still think this is a good business, and market obviously just a little out of love with it. More recently, we bought the iShares US Treasury bond. If memory serves, the duration on this fund is about 8 years. So it really picks a nice sweet spot in terms of giving you yield exposure, but not excessive capital risk if we happen to be caught wrong-footed on yield, which I don't think is going to happen. As I say, our view is that the Fed will cut, and if there are banana peels on the floor and they need to pull growth higher through aggressive monetary policy, they will do it. And that obviously is in the interests of the American Treasury, because there's a lot of paper in issue and they really do need to get the cost of debt down. So tactically, at least, we think it's a decent bet. We're probably looking at about an 18-month, maybe 2-year window, and then we would probably look to exit these and move back into shorter duration if the plan works. All right, BMW actually has performed very, very nicely for a long time. It looked like the relative underperformer, particularly when compared with Volkswagen. But the model is definitely working, and BMW, as you saw, is definitely one of the stronger performers. All right, then we also, maybe prematurely, we're of the view that China is the economy to back if you had to back one big economy on a 20-year view. We understand it's a bumpy ride, but having said that, the demographic there definitely lends itself more to markets. So we believe that China, this underperformance, as you can see, this index has done virtually nothing for 5 years, with very bad underperformance over the last 2 or 3 years. We think that creates a great opportunity. Having said that, we are a little bit fearful of the shadow banking market. We are a little bit fearful of the banking market as well, and of course the property market, and that's why we quite like the fund that has as its biggest asset a very sizable brewer, the size of, at least in terms of volume, some of the giants in the world. All right, Brookfield Renewable Corp, we spoke about them last time. Obviously, interest rates spiking as quickly as they did hurt them, but we remain confident on the narrative. The bottom line is the world has got to go green in terms of electricity generation, and this asset is incredibly well positioned, not only to grow their balance sheet, but also to manage assets on behalf of governments and corporates. So the price has recovered from close to $30. We remain confident, even if slightly underwater, that this will work on the long term. Then Richemont, we took advantage of the sell-off in 2022. And it has recovered quite nicely. It's been quite volatile. In spite of fears around the luxury goods market, they are in the right part of the market and incredibly cash generative. So we are fairly confident that this business will do well over the next year or two. Then the iShares Core Stocks 50. You'll see there's 2 European funds. This is the Stocks 50, which is more concentrated in the heavyweights, as you can see, really just tracking what the stocks index does. So biggest holding ASML, which is obviously designs the technology to etch high performance chips, followed by LVMH, Total, SAP. As you can see there, financials representing 17%, with industrials at 16.8%. This was in large part just opportunistic to give a little bit of exposure to Europe after the aggressive sell-off. Then the other one we hold is the core, for some clients, is the core MSCI Europe ETF. It has underperformed the Stoxx 50 slightly. You can see it's broader based, so it's both large, mid, and smaller caps. You can see slightly more in financials, more in consumer discretionary, and a little bit relatively underweight in industrials. The biggest holdings there, you can see it's a lot more diversified. Novo Nordisk, Nestle, ASML, obviously in a smaller holding. So just a slightly different composition. But we actually quite like the idea of a broader-based European fund in concept. Then Prosus, obviously, as we discussed in the South African story around Naspers and Prosus, trading at over a 30%, 35% discount to NAV just seems excessive. This was a little bit opportunistic, and it was really just because we saw a unique opportunity to get a good asset cheaply, and were battling at the time to actually deploy capital into other assets. Haleon was unbundled out of GSK. Haleon is essentially the consumer/OTC portfolio. It's done quite nicely, but it's a very small holding in client portfolios. Although we like the portfolio, we haven't added more. We just wanted to settle down a little bit. Then General Electric has had, as we saw, a phenomenal year or two, but it's really just because of the very oversold position as they rebuilt their history. But yeah, massive value destruction, and just a really sad. So all that's left to say is thank you for watching. We hope that this was of value to you. We apologize, it's slightly over 35 minutes. We try to go as quickly as we could without diluting the message, but we trust this is of value. If you're interested in the performance and positioning of the Kerner Flexible Fund, please look out for the final video in the 5-part series that'll be released in the next day or two. Thank you very much for your time, and we wish you well. And as always, if you've got any questions or comments, you're most welcome to provide feedback, good or bad.